Obviously, it's not just the real estate market that's been going up, going down, going all over the place. It's really the stock market that has gotten all of you so afraid it's not even funny. The volatility has been all over the place. And tonight, our first guest, Kathy, she could not take it. The ups and downs of this market made her an absolute emotional wreck. She sold everything, I hear, last January. But Kathy, coming to us from Waterford, Connecticut, you have a question for me.
I do. Hi, Susie.
Hi, Kath.
Yes, I sold everything in January. I couldn't take it. My stomach was in knots.
Then why are you sighing, girlfriend? January was many months ago. You actually got out pretty close to the high. Remember, the high of this stock market was October 9th or 10th of 2007. We're at 14,000. In January, that was the most brilliant thing to do. So why are you so upset?
Well, because now I don't know what to do with it. It's sitting there in a cash investment trust account in my 401k.
Yes.
And I don't know what to look for in the market to get back into the market. When will the time be right? How do you know when you've hit the bottom, and how do you know what to get into and what's safe and what you can stomach?
All right, so here's the question for you. You're how old?
50.
All right, you're 50 years of age. How long do you think you have before you retire? And you'll need this money.
At least 15 years.
15 or 16 years. And what has always been my rule of thumb? Do you watch the Suze Orman Show?
Yes.
How long have you been watching the Suze Orman Show?
Oh, since way back
Forever, way back. So you know all the things that I want you to do and I don't want you to do. The hardest thing in life really is to time a stock market. Because while it may be that days you will see it go down 700 points, there will also be days that you see it go up almost 1,000 points. And the key is to stay in the game as long as you know you are in good quality stocks, mutual funds, exchange-traded funds. What makes something good quality? When it doesn't have a load on it, meaning you don't have to pay some financial advisor 5.75% to buy something. That is the biggest waste of money out there, bar none, but we can get to that in a second. When the expense ratios within the mutual funds are very low. So if you know that you have good performing overall mutual funds, exchange-traded funds, or individual stocks, then you rather be in the market than out of it. But all right, you got out of it. Yeah. Now your question is, when do you get back in? Is that correct?
Correct.
Now, my producers tell me, my dear Kathy, that you actually on your own, the day before, you know you're going to be talking to moi, you on your own decided to take 25% of your money and to go back into the stock market.
I did.
So what are you asking me for then?
You know, I've got everybody around me saying, we need to get back in, we need to get back in. And I said, well, I have to wait till I talk to Susie.
But you didn't wait. So you went in to a mutual fund that had a load on it. Did you not?
It was A shares.
Yes, so an A-share mutual fund is the type of fund that I've always said to you on the Suze Orman Show, the biggest mistakes, in my opinion, that you will make is to buy an A-share fund or a B-share fund. They're both loaded funds because that fund has to go up 5.75% or some percentage like that, just in order for you to break even to pay for the financial advisor who sold you that mutual fund. Now, in days like this, you want a fund that has to go up 5.75% just for you to break even? But okay, that's another discussion. You went in 25% of your money. Okay.
Right.
What I would be doing if I were you is I would be dollar cost averaging back into the stock market at this point in time. But I'm not sure I would be doing it 25%, 25%, 25%. I would be doing it since you got out of the market and you've been out for a while and we don't know if the markets are going up or down from here. I would be doing whatever amount of money that you have on the sidelines. I would be dividing that amount of money by 12. Let's say it's $120,000. If you divide it by 12, that's $10,000. I would be putting $10,000 a month back into the market over this next year. I would be dollar cost averaging. That way, if the market goes down, that $10,000 buys more shares, because when the market goes down, the price per share of whatever you're buying normally goes down. The more those prices go down, the more shares you're able to buy. If the prices go up, the less shares you're able to buy, but your dollars actually average over time, and no matter what happens, whether we go up or whether we go down, you will be okay. The biggest mistake that you will make is if you stop contributing to the stock market at this point in time within your 401k. Now is the time to continue every single month to be putting that money into the stock market. In fact, hopefully with your new contributions that you were making, I hope they were going into the stock market, because this market went down considerably and you would have been buying more shares. So dollar cost average, don't get afraid, and just be aware, listen to yourself rather than all these people around you that are panicking.